Question 1. An insurable interest in property must exist at what point in time for a property insurance policy to be valid? A. Only at the time of policy application. B. Only at the time of loss. C. Both at the time of policy application and at the time of loss. D. At any point during the policy period, but not necessarily at loss. Answer: B. Only at the time of loss. For a property insurance policy to be valid and allow for recovery, an insurable interest must exist at the time of loss. This means the policyholder would suffer a financial loss if the insured property were damaged or destroyed. While having an interest at the time of application is common, the critical requirement for a claim to be paid is that the policyholder has a financial stake when the loss occurs. Remember, without an insurable interest at the time of loss, insurance would be akin to gambling, which is against public policy. Question 2. What is the primary purpose of a deductible in an insurance policy? A. To increase the insurer's profit margin. B. To reduce the number of small claims and control moral hazard. C. To eliminate the need for premium payments. D. To cover losses that exceed the policy limits. Answer: B. To reduce the number of small claims and control moral hazard. The primary purpose of a deductible is to reduce the number of small claims submitted to the insurer and to help control moral hazard, which is the increased likelihood of loss because of insurance coverage. By requiring the insured to pay a portion of the loss out of pocket, deductibles encourage policyholders to be more careful and to only submit claims for significant losses, thereby making insurance more affordable for everyone. Think of it as your initial financial participation in a loss before the insurance company steps in. Question 3. Under a standard homeowner's policy, which of the following is considered coverage? D. Loss of use. A. The cost to repair the damaged dwelling. B. The personal property stolen from the home. C. Additional living expenses incurred while the home is uninhabitable due to a covered loss. D. Liability coverage for injury to a guest. Answer: C. Additional living expenses incurred while the home is uninhabitable due to a covered loss. Coverage D, known as loss of use or additional living expense, ALE, in a homeowner's policy, provides coverage for expenses incurred when the insured dwelling becomes uninhabitable due to a covered peril. This includes costs like hotel stays, restaurant meals, and laundry services that exceed the family's normal living expenses. For example, if a fire makes your home unlivable, Coverage D helps pay for your temporary housing and food costs while repairs are underway. This coverage aims to maintain your normal standard of living during a disruption. Question 4. An insurance policy is considered a contract of adhesion. What does this mean? A. The policy can be modified by either party at any time. B. The terms of the policy are negotiated and agreed upon by both parties equally. C. The insurer writes the contract, and the insured must accept or reject it as is. D. The policy is legally binding only if signed by both the insurer and the insured. Answer: C. The insurer writes the contract, and the insured must accept or reject it as is. An insurance policy is a contract of adhesion, meaning it is prepared by the insurer and accepted or rejected by the insured as a take-it-or-leave-it agreement, without negotiation of its terms. This characteristic means that if there is any ambiguity in the policy language, a court will usually interpret it in favor of the insured, as the insurer had the power to draft the terms clearly. This principle protects consumers from potentially unfair or unclear terms imposed by a powerful party. Question 5. In Georgia, what is the minimum bodily injury liability coverage required for a single person in an auto insurance policy? A. $10,000. B. $25,000. C. $50,000. D. $100,000. Answer: B. $25,000. In Georgia, the minimum bodily injury liability coverage required for a single person is $25,000, commonly expressed as part of a 25/50/25 split limit. This amount covers the costs for injuries to one person in an accident for which the insured is at fault. It's crucial to know these minimums for licensing, but remember that many drivers choose higher limits for better protection against significant financial liabilities. Question 6. All of the following are essential elements of a legal contract of insurance except A. Offer and acceptance. B. Legal purpose. C. Unilateral agreement. D. Consideration. Answer: C. Unilateral agreement. While an insurance contract is indeed a unilateral agreement, meaning only one party, the insurer, makes a legally enforceable promise, it is a characteristic of the contract, not an essential element required for its formation. The four essential elements of any valid contract, including insurance, are offer and acceptance, agreement, consideration, exchange of value, competent parties, legal capacity, and legal purpose, not against the law. Unilateral is how it operates once formed, but not what forms it. Question 7. Which of the following best describes the principle of indemnity in insurance? A. An insured can profit from a loss. B. An insured should be restored to the same financial condition as before the loss, without profiting. C. An insurer is always obligated to pay the full policy limit regardless of the actual loss. D. An insured must always have an insurable interest at the time of policy purchase. Answer: B. An insured should be restored to the same financial condition as before the loss, without profiting. The principle of indemnity states that an insured should be restored to approximately the same financial condition as they were in immediately prior to the loss, without profiting from the loss. This means insurance aims to make the policyholder whole, not to provide a financial gain. For example, if your $5,000 roof is destroyed, you will receive up to $5,000 to replace it, not $10,000. This principle prevents moral hazard and maintains the true purpose of insurance as protection against loss. Question 8. What is the purpose of a binder in property and casualty insurance? A. To permanently replace a policy declaration page. B. To provide temporary insurance coverage until a formal policy is issued. C. To cancel an existing insurance policy. D. To serve as proof of policy renewal. Answer: B. To provide temporary insurance coverage until a formal policy is issued. A binder provides temporary insurance coverage, usually for a short period like 30 to 60 days, until the actual insurance policy can be issued or declined. It serves as proof of coverage for the insured during this interim period, allowing transactions like property closings to proceed. For instance, when buying a new home, a binder ensures you have immediate protection from the moment you take ownership, even before the physical policy document arrives. Question 9. Under the Georgia Motor Vehicle Accident Reparations Act, no-fault law, what is covered by personal injury protection, PIP, benefits? A. Only property damage to the insured's vehicle. B. Bodily injury to third parties caused by the insured. C. Medical expenses and lost wages for the insured and their passengers, regardless of fault. D. Comprehensive and collision coverage for the insured's vehicle. Answer: C. Medical expenses and lost wages for the insured and their passengers, regardless of fault. Although Georgia is no longer a true no-fault state, the Georgia Motor Vehicle Accident Reparations Act, commonly referred to when discussing PIP, initially focused on personal injury protection, PIP, benefits. Historically, PIP covered medical expenses, lost wages, and other specified expenses for the insured and their passengers, regardless of who was at fault in an accident. While compulsory PIP was repealed, understanding its core function of providing first-party benefits for bodily injury regardless of fault is important for historical context in the exam. Question 10. Which of the following is considered a peril in insurance? A. A faulty electrical wiring system. B. A careless smoker. C. A fire. D. An unlocked door. Answer: C. A fire. A peril is defined as the cause of loss. In this context, a fire is an event that directly causes damage or destruction. Faulty electrical wiring and an unlocked door are examples of hazards, conditions that increase the probability or severity of a loss, and a careless smoker might be considered a moral hazard. Think of it simply: the peril is what happens to cause the damage. Question 11. What type of authority does an insurance agent have when explicitly granted by the insurer, typically in the agent's contract? A. Apparent authority. B. Implied authority. C. Express authority. D. Fiduciary authority. Answer: C. Express authority. Express authority is the explicit, clear, and unambiguous authority granted to an agent by the insurer, usually in writing within the agency agreement or contract. This type of authority clearly defines what actions the agent is permitted to perform on behalf of the insurer. For example, if an agent's contract states they can bind coverage up to a certain limit, that is express authority. It's the most direct form of authority given. Question 12. A policy that covers all perils except those specifically excluded is known as what type of coverage? A. Named peril. B. Specific peril. C. Open peril, or all risk. D. Broad form peril. Answer: C. Open peril, or all risk. An open peril policy, often referred to as all-risk coverage, provides protection against all causes of loss unless explicitly excluded in the policy. This type of coverage offers broader protection compared to a named peril policy, which only covers losses caused by the peril specifically listed. For example, if your policy covers all perils except flood, then any damage not caused by flood would be covered. Always check the exclusions to understand the limits of an open peril policy. Question 13. Which section of a homeowner's policy covers the dwelling itself? A. Coverage A. B. Coverage B. C. Coverage C. D. Coverage D. Answer: A. Coverage A. In a standard homeowner's policy, Coverage A is specifically designated for the dwelling, which includes the house structure and any attached structures like a garage. This is the primary coverage for the main building and is typically the largest coverage amount. Remember, A is for abode or actual house, to help you recall this foundational coverage. Question 14. What is the purpose of subrogation in an insurance policy? A. To allow the insured to recover from both the insurer and the at-fault party. B. To prevent the insured from collecting twice for the same loss. C. To increase the premium charged to the insured. D. To transfer the insured's rights of recovery to a third party. Answer: B. To prevent the insured from collecting twice for the same loss. Subrogation is the legal right of an insurer to pursue a third party that caused an insurance loss to the insured. Its primary purpose is to prevent the insured from collecting twice for the same loss, once from their insurer and again from the negligent third party. For example, if your car is hit by a negligent driver, your insurer might pay for repairs, then step into your shoes to recover that money from the at-fault driver's insurance company. This principle reinforces indemnity. Question 15. The declarations page of an insurance policy includes all of the following except: A. The named insured's address. B. The policy period. C. The perils covered. D. The premium amount. Answer: C. The perils covered. The declarations page, often called the deck page, is the front page of an insurance policy that summarizes key information specific to that policy, such as the named insured's name and address, the policy period, effective and expiration dates, and the premium amount. The specific perils covered, or excluded, are detailed in the insuring agreement and exclusions sections of the policy, not typically on the brief declarations page. Think of the declarations page as a quick snapshot of who, what, when, and how much premium for the policy. Question 16. What is misrepresentation in the context of an insurance application? A. An intentional act of omission or concealment of a material fact. B. An intentional misstatement of a material fact made by an applicant. C. An unintentional error in reporting personal information. D. Providing advice beyond the scope of an agent's license. Answer: B. An intentional misstatement of a material fact made by an applicant. Misrepresentation refers to an intentional misstatement of a material fact by an applicant for insurance. A material fact is one that would influence an insurer's decision regarding issuing a policy or setting the premium. For example, falsely claiming you have never had a prior auto accident on an application would be a misrepresentation. This differs from concealment, which is intentionally withholding a material fact. Question 17. Which of the following is typically covered under coverage C, personal property in a homeowner's policy? A. The structure of the insured's detached garage. B. The insured's clothing and furniture inside the dwelling. C. Damage to the neighbor's fence caused by the insured. D. The land on which the dwelling is located. Answer: B. The insured's clothing and furniture inside the dwelling. Coverage C of a homeowner's policy is specifically designed to protect the insured's personal property, which includes items like clothing, furniture, electronics, and other belongings. This coverage generally applies whether the property is at the insured's home or anywhere else in the world, subject to certain limits and exclusions. Remember, coverage C covers your stuff, not the house itself or other structures. Question 18. An insurance company's ability to pay claims is directly related to its A. Number of agents. B. Financial strength and solvency. C. Marketing budget. D. Customer service ratings. Answer: B. Financial strength and solvency. An insurance company's ability to pay claims, which is its fundamental promise, is directly tied to its financial strength and solvency. Solvency means the company has sufficient assets to meet its financial obligations. State regulatory bodies, like the Office of Commissioner of Insurance in Georgia, closely monitor insurer solvency to ensure they can fulfill their promises to policyholders. Always consider an insurer's financial ratings when choosing a policy. Question 19. If an insured cancels a policy before its expiration date, and the insurer retains a portion of the unearned premium as a penalty, this is known as what type of cancellation? A. Flat cancellation. B. Pro rata cancellation. C. Short rate cancellation. D. Earned cancellation. Answer: C. Short rate cancellation. A short rate cancellation occurs when the insured cancels the policy before its expiration date, and the insurer retains a slightly larger portion of the premium than the actual earned premium. This extra retained amount acts as a penalty for early cancellation. In contrast, a pro rata cancellation happens when the insurer cancels, returning all unearned premium without penalty. Question 20. In property and casualty insurance, what does the term actual cash value, ACV, mean? A. The cost to replace damaged property with new property. B. The original purchase price of the property. C. Replacement cost minus depreciation. D. The market value of the property prior to the loss. Answer: C. Replacement cost minus depreciation. Actual cash value, ACV, is a method of valuation that determines the reimbursement amount for damaged property by taking the replacement cost, the cost to replace with new property, and subtracting depreciation, wear, tear, and obsolescence. For example, if a 10-year-old sofa costs $1,000 new but has depreciated by 50%, its ACV would be $500. This calculation ensures the principle of indemnity is upheld, preventing the insured from profiting from the loss. Question 21. What is the primary purpose of liability coverage in an insurance policy? A. To cover damage to the insured's own property. B. To pay for medical expenses of the insured and their family. C. To protect the insured against financial loss due to legal responsibility for injury or damage to others. D. To provide coverage for losses caused by natural disasters. Answer: C. To protect the insured against financial loss due to legal responsibility for injury or damage to others. The primary purpose of liability coverage is to protect the insured against financial loss if they are found legally responsible for causing bodily injury or property damage to another person. This coverage pays for the injured party's damages and often includes defense costs, even if the insured is ultimately found not liable. For instance, if you accidentally hit someone's car, your liability coverage pays for their car's repairs and any injuries they sustain. It's all about protecting you from claims made by others. Question 22. What is an endorsement in an insurance policy? A. A section that outlines the basic coverage provided. B. A provision that reduces the policy's overall coverage. C. A written amendment added to a policy to modify its terms, conditions, or coverages. D. A statement of facts made by the insured on the application. Answer: C. A written amendment added to a policy to modify its terms, conditions, or coverages. An endorsement, also known as a rider, is a written amendment added to an insurance policy to modify its existing terms, conditions, or coverages. Endorsements can add, delete, or change coverage, tailoring the standard policy to specific needs. For example, adding an earthquake endorsement to a homeowner's policy would provide coverage for a peril not typically included in the standard form. Endorsements are essential for customizing policies. Question 23. An insurance agent who acts on behalf of the insured, rather than the insurer, is typically referred to as an A. Exclusive agent. B. Captive agent. C. Independent agent. D. General agent. Answer: C. Independent agent. An independent agent typically represents multiple insurance companies and acts as a representative of the insured, helping them find the best policy and coverage from various insurers. Unlike captive or exclusive agents who represent only one insurer, independent agents can shop around on the client's behalf. This independence allows them to prioritize the client's needs by comparing different offerings. Question 24. Which of the following losses would typically be excluded under a standard homeowner's policy? A. Damage from a fire. B. Damage from a burst pipe. C. Damage from an earthquake. D. Damage from vandalism. Answer: C. Damage from an earthquake. While a standard homeowner's policy covers many perils like fire, theft, and burst pipes, certain catastrophic events are typically excluded. Earthquake is one of these common exclusions, along with flood, war, and nuclear hazard. If an insured wants coverage for an earthquake, they usually need to purchase a separate endorsement or a specialized policy. Always remember that for major natural disasters, you often need specific coverage. Question 25. What is twisting in the context of insurance unfair trade practices? A. Misrepresenting the terms of a policy to induce a policyholder to lapse or surrender an existing policy for a new one with the same insurer. B. Making false or misleading statements about an insurer's financial condition. C. Offering a prospective insured a special inducement not specified in the policy to buy insurance. D. Inducing a policyholder to lapse or surrender an existing policy for a new one with another insurer, to the policyholder's detriment. Answer: D. Inducing a policyholder to lapse or surrender an existing policy for a new one with another insurer, to the policyholder's detriment. Twisting is an illegal unfair trade practice where an agent or insurer induces a policyholder to lapse or surrender an existing policy to purchase a new one from a different insurer, often based on misleading comparisons or to the detriment of the policyholder. This practice aims to generate new commissions for the agent, potentially leaving the client with less suitable coverage or higher costs. It's considered unethical because it often harms the client's financial position for the agent's gain.